Have you ever stopped to wonder what actually prevents the global economy from just collapsing in on itself every single day? I mean, we tap our cards, we send wires, we buy stocks, and the money just magically appears exactly where it needs to be. Well, in today's explainer, we're going to dive deep into that hidden financial architecture, the invisible plumbing of global finance. We're going to see exactly how central banks diffused what was essentially a ticking time bomb right at the heart of our banking system.
Okay, several trillion dollars. Take a second to let that number sink in. And no, we're not talking about a country's annual GDP here. That is the estimated amount of money transferred between banks in the G10 countries every single day. We are talking about massive, large value funds transfer systems that banks use to settle up with one another. The stakes here are absolutely astronomical. If this plumbing clogs up, even for just a few hours, the entire global financial market basically seizes up.
So here is our roadmap for this explainer. First, moving trillions daily. Second, the danger of the settlement lag. Third, enter the RTGS system. Fourth, the liquidity catch. And finally, managing the money traffic.
Section 1. Moving trillions every day. The basics of transfer.
To really understand this, we need to look at two foundational methods. Net settlement is kind of like splitting a massive tab at the end of the night. It batches credits and debits all day long, and then banks just reconcile the net difference at the end of the cycle. Gross settlement, on the other hand, is like paying exact cash up front for every single transaction. It requires continuous, transaction-by-transaction funding. So it's really the difference between tallying up a huge batch process versus streaming exact liquidity in real time.
Section 2. The danger of the lag. A systemic threat.
You see, historically, global banking relied heavily on that first method, net settlement. But as those daily volumes scaled up into the trillions, a critical flaw emerged. Let's walk through the timeline. At time T1, a payment message enters the system. By T3, the receiving bank gets the information. And because they want to keep their customers happy, they might instantly credit that customer's account. But the actual interbank settlement of hard cash, that doesn't happen until T4. That dangerous gap right there, that is what we call the settlement lag.
Which leads us to a pretty terrifying scenario. What happens if the sending bank suddenly goes bankrupt between T3 and T4? Think about it. The receiving bank has already paid its customer, but now they are never going to receive the actual funds from that bankrupt sender. Suddenly, they are facing a massive, totally unexpected loss. And if that loss is big enough, the receiving bank defaults on its own debts, which causes a third bank to fail and then a fourth. It's the ultimate nightmare for central banks, a systemic domino effect triggered by nothing more than a simple timing gap.
Section 3. Enter RTGS, the real-time hero.
To stop this trillion-dollar domino effect, central banks deployed something called real-time gross settlement, or RTGS. And the really fascinating thing here is its core mechanism, a concept called intraday finality. The Knoll report highlights this as the system's absolute superpower. It ensures that transfers between central bank accounts become irrevocable and unconditional almost instantly during the day. There's no waiting around until the end of the cycle to settle up anymore. If the message arrives, the money has legally and permanently arrived with it. The lag is completely gone, and that dangerous domino effect is neutralized.
This is a massive structural shift for the whole industry. We're moving from designated time net settlement, which, as we saw, is highly vulnerable to built-up end-of-day credit risk, to real-time gross settlement. It's a continuous flowing system where individual transactions are settled instantly in central bank money. It effectively strips the credit risk right out of the interbank plumbing.
Section 4. The liquidity catch. The traffic jam.
But of course, there's a catch. If you settle continuously, transaction by transaction, you need massive amounts of liquid cash on hand all day long. To prevent their outgoing real-time payments from bouncing, banks have to constantly juggle four main sources of liquidity. They've got their starting balances at the central bank, incoming transfers from other banks, intraday central bank credit extensions, and rapid money market borrowing. They are perpetually scrambling between these four buckets just to keep the money flowing.
And when that juggling fails, the entire system can stall out completely. Let's look at a gridlock scenario. Take Bank A. They're sitting on a starting balance of 100, while banks B, C, and D have 0. Now imagine B needs 10 to send a Q transfer, C needs 20, and D needs 30. The system actually has enough total money to clear all 60 units of those Q transfers. But because all 100 units of liquidity are hoarded by Bank A, and Bank A isn't sending anything out, we hit a total system gridlock. The money's there, but the distribution is completely jammed.
Section 5. Managing the money traffic, clever algorithms.
So how did they survive these gridlocks? Well, central banks step in and act a lot like elite air traffic controllers. Now, a strict first in, first out queue is incredibly dangerous here because one massive payment can literally block the whole pipe for everyone else. Instead, systems use bypass FIFO to let smaller, affordable transactions slip right past the blockage. And in really severe jams, optimization routines fire up. These are complex algorithms that find offsetting payments between multiple banks and settle them all simultaneously, which instantly breaks the gridlock.
Then there's the immense challenge of routing the actual data securely. Different architectures handle this in really clever ways. V-shaped structures route the full payment message directly through the central bank first. Y-shaped structures, on the other hand, only send a tiny core subset of data to the central bank for settlement, keeping the main business details strictly private. And L-shaped structures hold the data at a gateway, only releasing it to the receiving bank after the settlement is confirmed. The big takeaway here, in every single model, the receiving bank never mistakenly gets the actionable message until the cash is fully finalized.
Ultimately, by eliminating that settlement lag and enforcing intraday finality, these systems provide an absolutely vital mechanism for limiting systemic risks. They are the invisible algorithms and precise data structures, quietly shielding the global economy from a catastrophic domino effect every single day.
So as we wrap up this explainer, I want to leave you with this thought. If the deepest plumbing of global finance relies on bypassing queues and routing data in V and Y shapes just to prevent absolute economic collapse, how secure do you think your own daily digital transactions really are? It certainly changes how you view that instant notification on your banking app, doesn't it? Thanks for exploring the hidden systems running our world with me.